just four students online. Maybe they thought we are going to start late. All right. We bless God for the month of September. I think this is my first lecture in September. We shall continue with the topic we started last week, divisional performance evaluation. Okay, number is increasing. That's fine. While we await others to join the class, let us take a recap of our last class. Our last class was on divisional performance. Of course, the class will still continue today, where we explained that the topic is about evaluating the performance of divisions within an organization, where a company is operated along divisional structure. The management must introduce suitable performance measure where a company is segmented along the divisional structure. The company's management must introduce divisional performance measures. That is, how do we evaluate the performance of our individual divisions? Are we sure these divisions are doing well? So management must introduce suitable performance measure. We explained that we have financial performance measure, whereby we use financial figures or accounting figures to evaluate the performance of the division or divisional manager. I will take that again. We explained that we have financial performance measures. When we say financial performance measures, we are looking at those measures that uses accounting figures or financial data to assess performance. Under the financial performance measure, we have return on investment. Our return on investment is a financial performance measure or method that relates profits achieved to the amount of resources invested in a division. Return on investment is a financial performance measure that uses or that relates the profit derived to the amount of resources invested in a division. You can calculate return on investment as operating profit divided by the capital employed multiplied by 100. We explained this last week. We equally explain residual income. Residual income can also be used to assess the performance of a division or that of the divisional manager. Residual income is calculated as the excess of operating profits, over the cost of capital. That is our operating profits minus the cost of funds. Your cost of funds is the amount paid to the providers of funds. Your cost of funds is the amount paid to the providers of capital. Who are the providers of capital? The shareholders and the debt holders. When we say providers of capital, people that has contributed money to support the company operation. We have the shareholders and we have the debt holders. The shareholders are the owners of the business. However, they also borrowed money. The money borrowed will be categorized under debt holders. We explained these two last week, and we were able to put question to these two last week. Today we shall continue with our explanation. We have just solved one question relating to this topic. Definitely we are going to take one more question relating to this. But before that, let us explain the third financial measures. Before we go to question, we want to explain the third financial measure of performance, which is economic value added. I'm assuming the class is fuller now. Okay, the class is much fuller. We are going to start with economic value added. What is economic value added? How do we compute economic value added? Why is it different from the two methods we have used? All right. Let us set, please just 1 minute. 1 minute. Please 1 minute. I'll be back. Our discussion is on ever. Let me expand this more. Okay. All right. Economic value added. Economic value added as a measure of performance is very similar to residual income. Economic value added as a measure of performance is very similar to residual income. However, unlike residual income, economic value added uses economic profits and economic capital employed. I will take that point again. Economic value added is very similar to residual income, except that the profit figure used is the economic profits, and the capital employed figure used is the economic capital employed. Under residual income, We make use of accounting profits and accounting capital employed under the residual income. We use accounting profits. You are going to pick your accounting operating profits. You are going to use your accounting capital employed. That is what we do under residual income. But when you get to economic value added, you are not going to use accounting profits. You are going to use economic profits. And you are going to use economic capital employed. It is argued that accounting profits and capital employed figures in the financial statements, the accounting profits and the capital employed figures stated in our financial accounts do not give true performance of the company. This is because accounting figures are subject to distortion. Accounting figures are prepared based on assumptions and conventions. Hence, using accounting figures to assess performance may not give us the true performance of the company. In other words, economic value added is to correct the deficiency of residual income. In other words, the economic value added is to correct some of the deficiency of residual income. Economic value added is based on the assumption that performance should be evaluated based on the value created. Economic value added is based on the principle that performance of a division or a divisional manager or the performance of the company as a whole should be evaluated on the basis of the value created, on the basis of the value generated, not accounting figures generated. Because accounting figures are prepared based on assumptions and convention. When you get to economic value added, we are going to disregard accounting assumptions. We are going to look for economic profits. Now, to calculate your economic value added, please look at the formula. Economic value added is calculated as net operating profits after tax minus, open a bracket, adjusted, let me put it here. Adjusted, there is better that way. Adjusted capital employed multiplied by the cost of capital. Your economic value added is calculated as net operating profit after tax minus, open a bracket, adjusted capital employed multiplied by the weighted average cost of capital. Your weighted average cost of capital is your cost of capital. Now, the question is, how do we determine net operating profits? How do we determine adjusted capital employed? Then how do we determine the cost of capital? To calculate EVA, we require three variables. One is NOPAT, net operating profit after tax, minus, open a bracket, adjusted capital employed, multiply by your cost of capital. Your cost of capital is represented by the weighted average cost of capital. So how do we compute NOPAT, net operating profits after tax? Please look at the formats. Please look at the formats.
Raise it up a bit, sir.
Definitely. Are we? In fact, please allow me to go to whiteboard. I want to demonstrate it on the whiteboard. Let me open a whiteboard, because some information there are not good enough. Might create confusion. I'm trying to enable a whiteboard. All right. Let me enable a whiteboard. Let's go to the whiteboard. I want to demonstrate this on the whiteboard. You may take down. I've shared a whiteboard. I hope you can see it.
Yes, sir.
Let's continue, please. All right. Oh, sorry. My pad is. Don't wonder what I want. Why am I not seeing my pad? All right. To calculate your EVA, EVA is the shortening of economic value added. The formula is just 1 minute. All right, let's go to this. Formula is notepad minus brackets adjusted capital employed. Please, if you are solving question, I might not write this formula all the time again to save time. We are consuming a lot of time with this board. Multiply by cost of capital. You can please note it down. in bracket. So to calculate my notepad, you are going to have your 2 naira sign. You start with your profit after tax. Items to be added. Items to be added. 1, accounting depreciation. Going to add back accounting depreciation. X. Let me take a double X. Two. Item 2, you have for doubtful debts. For doubtful item 2, item 3, other provisions. Other provisions such as the VAT taxation provisions should be added. Item 3 and item 4, you have development costs. Development costs. Add. Item 5, you have interest nets of tax. Add back. Item 6, non-cash items. Add back. These 6 items will be added back. If you look at accounting depreciation, there's no cash involved. Accounting depreciation is just an accounting convention. You are depreciating your assets as an accounting convention. But no cash is leaving the system. Hence, we are going to add back. If you look at provision debt, that we make sales on credit. We have not collected cash. We now make provision for doubtful debt. Not happened. That is whatever is saying that accounting figures are based on assumptions, and you are making provisions for what happened. You are distorting the accounts. You are distorting performance. You are going to add back. Other provisions, such as provisions for the VAT taxation, it's an accounting assumptions which does not reflect reality. You are going to add back. Developmental cost, research and development cost should not be deducted at once. If a company engage in research and development and a new product is developed, the cost incurred for research and development should not be deducted at once. That cost should be amortized because we are going to develop. We create value for the company. Hence, the cost incurred should be spread for the number of years value is created. So developmental, it must be added back. Next, interest net of cash. Of course, if you are taking, that means we have deducted interest. That interest should be added back. And you are, when we say interest net of tax, you are going to remove tax from your interest. We have non-cash, other non-cash items. When we have non-cash items in a question, that non-cash item, that means there's no cash movement. We want a profit reality, a profit that will reflect what? Cash performance, not I've consistently advised these students. It is your network that is breaking.
Sir, it's not our network, sir. It's from you.
It's not our network.
My end too. Yes, sir.
So it's my network.
Yes, sir.
Is your Glow network, sir?
I don't use glue. I've never buy glue in my life. I've never bought one glue in my life. MTN or Airtel. I'll try, I don't know. Okay, so I've explained net of tax. Our interest net of tax is the interest cost minus the tax rate. When we get to computation today, we are going to demonstrate that. Then lastly is other non-cash items. When you are giving other non-cash items, you are going to add back other non-cash items. So these 6 items will be added back. Let's continue. You are going to get a figure for here when you add the 6. You now have items to be deducted. Items. So please just 1 minute, deducted. Yes, you can answer your question now.
Well done, sir.
Yes, sir.
We know depreciation to be a non-cash item in accounting. Likewise, provision. But the number 6, you raise it again as non-cash. What are other examples other than the depreciation and the whatever that will be included as non-cash in 6?
Okay, just 1 minute. I will explain that. Okay, items to be deducted, we have economic depreciation. In most cases, examiner will give you the economic depreciation. Item 1 to be deducted is economic what? Depreciation. Item 2 to be deducted, I will manage this place, is what we call amortization of development costs. Please, let me put it here. We call it amortization. Amortization of development costs. So you have these 2 items. You are going to deduct these 2 items. So I will answer your question. So your notepad will be profit after tax plus items to be added minus items to be deducted. That will give you your notepad, your figure here. Please note this. A very good question, or rather an intelligent question, that we know depreciation and provision to be non-cash items. What are other non-cash items that can happen? Is what we call notional interest or notional cost. What is notional interest? If you loan your business money, you have a business you are running yourself. You now give loan to the business. Under accounting rule, you are going to assume that you have borrowed the money from third party. Remember, you are the one giving the loan to your business yourself. That business belongs to you. You now say, okay, I'm giving a loan to my business. Under accounting principle, we are going to assume that that loan is coming from a third party. We are going to calculate interest and pay the provider of that loan. But in reality, because it's your business, no interest is leaving your company. That's a notional cost. Another example is if you have gotten a property of your own, maybe by way of inheritance, you have gotten a property from your father, which you use for your business. You have gotten a property from your father or your mother now, and you are using that property for business. Definitely, you are not paying rent to anybody. Definitely, you are not paying rent to anybody. Now, you are going to assume that you are paying rent. You are not going to include rent into your expenses. But in reality, you are not paying any rent. That rent will be categorized as notional rent because no cash flow is leaving your business. So we also categorize all those items. Is that better, sir?
Yes, sir. Thank you, sir.
All right. Now, when you are done with calculating your notepads, the next calculation is your adjusted capital employed. Please note this down. I'm not sure. Anyway, I'm going to share this anyway. This is the first working you are going to do. This is your second working. Adjusted capital employed. Please look at it. You are going to start with opening capital employed balance, double S, plus operating lease, assets, add it, plus increase in provision. If there is increase in provision, you are going to add it. How do we know there's increase in provision? You are going to compare the provision in the income statement with the provision in the statement of financial position. How do we know if there's increase in provision? You are going to compare the provisions in your income statements with the provision in the statement of financial position. If there's increase in provision, you are going to add back. But if there's decrease in provision, look at it, please. Minus decrease in provisions. You are going to less this. This we now, okay, there's still one more, please. Plus non, please, we are not going to take depreciation away. Specifically, examiner will tell you that these are non-cash items plus non-cash items.
Hello?
Yes. These 5 items will give you your adjusted capital employed. Let me make a clarification here. The capital you employ, you are going to pick. Depreciation is not deducted from it in the first place. The capital employed figure, depreciation is not deducted from it. Hence, you don't need to add back accounting what? Depreciation. Is that clear, please? What is deducted from it? I can't get that. That voice is breaking.
Sir, I said you should please come again. I didn't get what you just explained about the capital employed.
You know, if you look at the last item, we said add back non-cash item. And I said, please, your non-cash item you are adding back, do not take accounting depreciation. Because the capital employed figure we are taking, we have not deducted depreciation. So we don't need to add back depreciation. Then the last item to be calculated is your cost of capital. In some question, you may not be given the cost of capital. In that case, you need to compute your cost of capital. Your cost of capital is equal to your WACC. Your WACC is your weighted average cost of capital. How do we compute this? Please look at the computation. This is equal to KE multiplied by percentage of E, capital letter E, close my bracket, plus KDC multiplied by percentage of debt. Please, even though I'm going to share this, you can take it down. Your KE is your cost of equity. Is equal to cost of equity. Examiner will give you this in the exam. Your KDT is cost, is after tax cost of debt. We also call it cost of debt net of tax. Can call it cost of debt net of tax. No space again, no. Please document. Percentage of E is percentage of equity. Percentage of D is percentage of debt. Please document percentage of E.
We can hear you, sir.
Okay.
What do you mean, sir, by the percentage of equity?
Please let me write it. Percentage of equity. Percentage of debt. Any other question?
What of the KE and then the KDT?
That's the one I define first now. That's what I define first.
Question is, sir.
Again, sir.
Let me go back to it. Please look at it here. I define KE first. Later, I define KDT. Are we fine now, please?
What is the meaning, sir, of the percentage of equity and percentage of debt?
The meaning? It now sounds funny. When you say percentage of equity, you know what they call equity? Equity is shareholders' money. If you buy shares in a company, that is your equity.
Yeah,
Is that clear, sir?
Clear. And
that's what I'm saying. Equity. Equity shares. Like Zenith is selling shares now. If you buy shares in Zenith, that means you are part of the owners of Zenith Bank. That is percentage of equity. Is that better, sir?
That's right.
Your debt is the money you borrow. I'm done with the explanation. Oh. I'm done waiting for question. Any question, please?
So you say most of this will be given in the question.
I said so, yes. You can't manufacture it yourself now. Do you understand? You cannot manufacture this figure yourself now. Yes, you don't, let me answer that. You see, if I say give me percentage of Zenith equity, you can't take it from your head. You have to go and they must give you Zenith Bank financial report. From that report, you are going Zenith Bank financial statement. They are not going to see Zenith Bank equity. It's not something you can work yourself. That's what I'm going to. Here's your question.
Thank you, sir. Under items to be added, we have non-cash items. And under items to be deducted, we have non-cash items. Why is he applying this item?
I think you are missing it together.
Okay.
I've explained 3 items to calculate ever. You require note parts, adjusted capital employed, and cost of capital. Is that clear, sir? Is that clear, sir? I now started with the first items, no parts, net operating profits after tax. Our net operating after tax, I explained how to compute it.
The calculation of adjusted capital employed. That is the other side where the item appear.
When you now get to adjust the capital employed again, you are going to adjust your capital employed. What are the items required? I listed them out. You know that when you prepare accounts, there are some items that will affect your income statement. They will still affect your balance sheet statement. Do you know that?
Yes, sir.
The same thing applies. Non-cash items will affect your income statement. It will also affect, it's also part of your current asset. It's part of your capital employed. Okay, please note. Like the question we solved last, we are giving the investments. If you have to calculate your capital employed, for your capital employed under, if you are dealing with residual income, or you are dealing with return on investment, assuming you are dealing with residual income, or you are dealing with return on investment, you know you are not going to adjust anything. Hello?
Yes. Profit over capital employed times 100.
Good. You know, if you have to calculate your return on capital employed, or you want to calculate your residual income, you are going to pick the capital employed without adjustment. If you have to calculate capital employed, let me calculate it as it. If you have to calculate your capital employed, residual income, or
as operating profit minus cost of capital.
Yeah, I'll still give you your accounting. I know what I will do. Your accounting capital employed. Accounting capital employed. Capital employed. If you are not given, it's calculated as total assets. You are total assets minus current liability. Current liabilities. Please note this. If you have to calculate your accounting capital employed, assuming you are not given expressly, you are going to pick your total assets. You are going to less current liability. Your accounting capital employed is used for residual income, and return on investment calculation. Is that point clear, please?
Yes, sir.
But if I get to economic value added, I must look for adjusted capital employed. Is that point clear, please?
Yes, sir.
Where's Olakunle? Is he online?
I don't understand.
I'm here, sir.
Joy, which one you don't understand? Tell me now. I want to go to question. Oh.
I don't know. The last two things that you just said, actually, my stuff disconnected, network disconnected me at some point.
Me, I know. See, when students have some question, at times they never even leave the system. Go and do something else. You just come back and say, you didn't say this. I know. Now, what I said is, at least you have been truthful. What I said is, we have 3 financial measures. We have return on capital employed, we have residual income, and we have economic value added.
Yes, sir.
If you have to calculate return on capital employed, it's calculated as operating profit divided by capital employed multiplied by 100. Is that not, please?
Yes, sir.
Now, the operating profit you are going to use is accounting operating profits. You just go to your account, pick your operating profits. Now, the capital employed figure you are going to use is your accounting capital employed figure. And I said, some questions, examiner will give you the capital employed directly. Some questions, examiner will give you the accounting capital employed directly. Some question you need to calculate it yourself. That's okay. If you are not giving the accounting capital employed, and you want to calculate it yourself, for the purpose of computing return on capital employed or computing residual income, your accounting capital employed is calculated as total assets minus current liabilities. Is that clear, man?
Yes, sir.
Now, if you now get to economic value added, when you get to economic value added, you cannot use accounting profits. You cannot use accounting capital employed. You are going to use net operating profit after tax. That net operating profit after tax is what we shown as this is what we show here, how to compute it. The note 1. When you are done with that, you now go to your adjusted capital employed. You cannot use accounting capital employed here. You are going to look for adjusted capital employed. This is how to adjust your capital employed. Then you now move to the last one, your work. You now compute your work. Is that clear, please?
Yes,
is that clear, please?
Yes,
all right. Because the question we are about to take will involve both economic value added, return on capital employed, and residual income, most likely. Now let's go back to our material. Please, so your network should not disappear. And my own should not disappear. I don't need to start explaining this again. It's just consuming my time. We have solved question 1. Let us look at question number 2. Yes. Joy, you are the one that will read. You are the speaker of this house.
Okay, sir. I should read.
By God's grace. Please, let's follow the question. I'll move it up. I know she has printed, but let me also move it up. All right, please, you can start.
Okay. Uzo Trucks Nigeria Limited is a company established 4 years ago to produce medical equipment. The
Right.
income statement and statement of financial position for 2019 and 2020 are as follows. Income statement. We have our particulars, we have the years, and we have our naira in million, our amount in million. Sales, 250 million naira in 2019, 280 million in 2020. Operating cost, 180 million naira in 2019, 200 million in 2020. Operating profit, 70 million naira, that's 250 minus 180, and 80 million naira for 2020, that's 280 minus 200 naira. Finance charges, we have 10 million naira and 40 million naira, which will give
Your
us.
finance charge is also your interest element. Please remember. Is that clear, please?
Yes, sir.
Your finance charge, they call it finance charge or finance cost, is also your interest. Oh, yeah, please continue.
Okay. So our operating profits minus finance charge will give us our profit before tax of 60 million naira in 2019 and 66 million naira in 2020. Now, tax at 25%, that's 15 million naira and 18 million naira. Our profit
Right.
after tax, which is our profit before tax minus the tax, is 45 million naira for 2019 and 48 million naira for 2020. Our statement of financial position. They gave us the particulars, the years, and the amount in million. Non-current assets. We have 350 million naira in 2019, 440 million naira in 2020. Current assets, we have 190 million naira in 2019, 260 million naira in 2020, which gives us a total of 540 million naira in 2019.
We can move out of this. Let's go to other information to save time.
Other information are given as follows. 1. Operating cost includes the following. Operating cost includes depreciation, provision for doubtful debts, research and development, and other non-cash items.
Okay, other non-cash items. Note number 2.
We're also giving economic depreciation. Economic depreciation is assessed to be 50.5 million naira in 2020. Economic depreciation includes any appropriate amortization adjustments. In previous years, it can be assumed that economic and accounting depreciation were the same.
Next note.
Tax is the cash paid in the current year, which is 16 million naira, and an adjustment of 2 million naira for deferred tax provisions. There was no deferred tax balance prior to 2020. The provision for doubtful debts was 2.5 million naira on the 2020 statement of financial position. Research and development is not capitalized in the accounts. It relates to a new project that will be developed over 5 years and is expected to be of long-term benefit to the company. 2020 is the first year of this project. The company had a non-capitalized leased assets of 18 million naira in January 2020. These assets are not subjected to depreciation.
Okay.
Cost of capital of Uzo Trucks, equity is 18%. Our debt.
Can you see it? Cost of equity 18%. Cost of debt pre-tax
6%. The capital structure of Uzo Trucks, equity is 60% and debt is 40%. The company
Can you also see we are giving this capital structure of Uzo Trucks, equity 60, debt 40. Please continue.
The company had the opportunity to invest in a solar project that would require the procurement of an equipment worth 3 million naira in January 2020 and run for a period of 5 years with a salvage value of 500,000. That's 0.50 million naira. generating a stable net cash flow of 850,000 naira. The applicable cost of capital is the associated weighted average cost of capital of the company. We are required to compute and evaluate the company's performance using average rate of return, which is ARR. 2, compute and evaluate the company's performance using economic value added, EVA parameter. 3, calculate the net present value of the solar project for the life of the investment. 7 marks.
All right, thank you very much. The question is about performance evaluation and project performance evaluation. Now, requirement 1 says, compute and evaluate the company's performance using average rate of return. 4 marks. Please note, average rate of return is the same thing as return on investment. Ladies and gentlemen, please note, average rate of return is calculated in the same manner as return on investment. So what we are asked to calculate in A is the return on investment by this company. Also, please note, it can also be called accounting rate of return. So please, in the exam, the examiner can ask you to compute return on investment. You may be asked to compute average rate of return. You may be asked to compute accounting rate of return. These 3 refers to the same thing and the same computation. Is that point clear, please?
Yes, sir.
All right. Let us move to whiteboard. Before then, if you look at the statement we are giving 2 years financial information. We have for 2019, we have for 2020. I have operating profit for 2019, 70 million. For 2020, 80 million. If you are giving such information and you want to calculate average rate of return, then you are going to look for the average operating profits and average capital employed. In this case, we are using accounting information. We are not adjusting the accounting information. Let us go to the whiteboard, please. My first calculation, okay, let me take a new whiteboard. Let me take a new whiteboard for this computation. All right, our first working. A. I'm to calculate average rates of return. Please, you are going to shorten this. Please look at it. ARR. The formula becomes average operating profits over average capital employed. Capital employed multiplied by 100. Please note, the reason why we introduce average is because we are giving more than one accounting information. Operating profit. I didn't complete this, sorry. Operating profit. The reason why we introduce average operating profit and average capital employed is because we have 2 years financial information. Now, to calculate my average operating profit, average operating profit, I'm going to pick operating profit for 2019. Please, what is operating profit for 2019?
70.
That is 70 million. I will also pick operating profit for 2020. That is 80 million. Please sum up.
150 million.
This will give me 150 million. I will now look for the average, meaning I'm going to divide by 2. The average is equal to 150 divided by 2. That will give me how much?
75 million.
75 million. Please note, you have calculated your numerator. It's looking like this thing is too much. This is our average operating profit. Operating profit. If you are given 3 years, that means you are going to add all the 3 years profits. You divide it by 3 to get the average. You have gotten your average operating profit. We now move to average capital employed. Can go down small. I need my average capital employed. First, you are going to get capital employed for 2017. Continue from here. For 2019, sorry. You are going to like this. For 2019, get capital employed. Capital employed. How do we compute this, please? Are we giving directly?
No, sir.
Assets
minus current liabilities.
Please, let's not waste time. What is the total asset in 2019?
540.
540 million. Minus current liabilities 2019.
40 million.
That means capital employed in 2019 is 500 million. Now go to 2020. What is the capital employed?
700.
Total assets?
700.
700 million. Minus current liability? 155. This will give me how much?
545.
545. I've gotten capital employed for 2019, capital employed for 2020. I will now look for average. Add the two together. Look at the average. Average is equal to 550, sorry, 500 plus 545 divided by 2. What's your answer, please?
522.5.
Thank you. The average is equal to 545. Is equal to 522.5 million. I cannot calculate my average rate of return. Average operating profit, 75 million, divided by average capital employed, 522.5, multiplied by 100. Please, final answer.
14.35%.
14.35%. You are done with your requirement A. You are done with your requirement A. You are done with your requirements A. Any question, please? We can move to requirement B.
Hello, sir.
Yes,
Please.
we are listening.
How do we arrive at that 540?
Okay, do you have the question with you? Do you have the question with you?
Yes, sir, yes.
Now go to the question for 2019. What is the total asset for 2019? Yeah, we are waiting for you, please.
Yeah, I've seen it. 540.
So please remember, capital employed. Accounting capital employed is calculated as total assets minus current liability.
Okay. I get it now.
Right. No, it's fine. So we can move to requirement 2 if there's no question. Requirement 2. Requirement B says, compute and evaluate the company's performance using economic value added parameters. We move to the whiteboard. B, calculate ever. Please, what's the formula now?
Economic
Net operating profit after tax
minus bracket
adjusted
capital employed.
Let me write it because someone will say, how do you get it again? Adjusted capital employed multiplied by the cost of capital. Okay. I will start with my effect working.
We can't see your whiteboard.
I can't see your whiteboard.
Okay, just 1 minute. Okay, that's true. I open new whiteboard, 2 new whiteboard. No, not this. All right, look at my whiteboard. Can you see it now?
Yes, sir.
So my first working, my NOPAT, net operating profit after tax. You have your 2 naira sign. Before I go to this, you know we are giving 2 years. We have 2019 and 2020. And the examiner says calculate economic value added. Are we supposed to calculate for 2019 or 2020? The question didn't say so. Please allow me to finish, please. If you are giving 2 years or more than 2 years, and you are asked to calculate economic value added, and the examiner does not specify the year, please, you are going to compute for the most current year. I will take that again. When you are giving more than 1 financial year information, and you are asked to calculate economic value added, and the examiner did not say that, do not specify or does not specify the year, you are going to calculate for the most current year. In this case, we are going to calculate for year 2020. In this case, we are going to calculate for year 2020. So our attention will be on information relating to year 2020. I will start with the profit after tax. Please, what is the profit after tax for year 2020?
48 million.
You pick it. Now come here. Items to be added. Accounting depreciation. Go check the question. What is depreciation for 2020?
28 million.
28.
Provision for doubtful debt. What is provision for doubtful debt for 2020?
2.8.
2.8
2.8.
Why?
2.8 million.
2020. Why? Why is it 2.8?
Oh, sorry,
Say your own
1.2.
now.
Sorry, it's 1.2.
Me, I know it's not 2.8. 1.2 million. Any other provisions for 2020? Please look at note number
Number 3.
Number 3. Hey, I don't the right provision.
Look at note number 3 or note number 2. Provision for deferred taxation. An adjustment of 2 million naira for deferred taxation provisions. There was no deferred tax balance prior to 2020. So that means in 2020, we have provision for deferred taxation, 2 million naira. I'll come here, add back. Provision for deferred tax, 2.0 million. Next. Do we have development cost in 2020?
No, sir.
No.
One in additional information.
Good. Non-cash items, 2020?
Sorry, sir, I have a question.
Yes, your question.
This note 3 that says the provision for doubtful debt was 2.5 million in the 2020 statement of financial position. What does it mean, please?
Okay. It says provision for doubtful debt was 2.5 million on the 2020 statement of financial position. That information is affecting your statement of financial position. It's not affecting your income statement. Your operating profit is coming from your income statement. We are still going to use this. Remember, when we get to adjusted capital employed, we are going to look for increase or decrease in provision. You are going to compare provision in the income statement with the provision in the statement of financial position. That will tell you if there is increase or decrease. This information will affect your adjusted capital employed, not your operating profits. Is that clear, please?
Yes, sir. Thank you very much.
The examiner was also very specific. Said provision for doubtful debt was 2.5 million on the 2020 statement of financial position. It didn't say income statement. All right. I was waiting for the question anyway. Other non-cash items 2020, how much?
3 million.
3 million, add back. We have taken 4. We don't have development costs for 2020. We only have for 2019. You can't add back. Then your interest net of tax. That is your finance charge. Interest net of tax. What it means is that go to 2020, pick the finance charge. Now remove tax from it. The balance, let's know the balance. What is the finance charge?
14 million.
That's 14 million. Now, what is our tax rate?
25%.
Now, you are going to compute 25% of that 14 million and now deduct the amount for 14 million. To do this, you can do this straight. Look at it, please. Your 14 million multiplied by 1 minus the tax rate. The tax rate is 25%, 0.25. This will give you your interest. This is how to compute interest net of tax. If you calculate this, you are going to get what?
10.5.
10.5. If you are getting confused with this, take your 14 million. First of all, compute the tax. Please compute 25% of 14 million. What do you have? Joy girl.
Yes, sir.
3.5
Wait,
million.
where's Tife? Tife is missing. Oh.
So I'm not missing. I'm here.
You have been silent now.
Yes, sir. I'm here. The answer is 3.5 million.
Now that 3.5, deduct it from 14 million.
10.5 million.
That is, look at the figure we have got, it 10.5 million. That is how to compute interest net of tax. When you are done, we have taken all the items to be added. Sum. Please sum and let's have the figure, total figure to be added.
44.7.
I have 44.7. Then I will now move to items to be deducted. Items to be deducted. One, economic depreciation. In most cases, the examiner will give you this figure. Look at your note number 1 or 2. What is the economic depreciation?
50.5.
50.5 million. Then we now come to amortization of development costs. Development costs. How do we do this? Let's go back to the question. No, this is not the question. No. Now look at note number 4. Research and development cost is not capitalized in the accounts. It relates to a new project that will be developed for over 5 years and is expected to be of long-term benefits to the company. Year 2020 is the first year of this project. Now, in 2019, this company incurred research and development cost of 5 million. This cost incurred to develop a new project. This new project is for 5 years and is going to give benefit to the company. In this case, their cost will be amortized for 5 years. That cost will be amortized for 5 years. When we say amortized, that cost will be spread for 5 years. We have incurred 5 million and is for a project for 5 years. That's okay. To amortize this cost, I'm going to say 5 million divided by 5 years. That means annually, 1 million will be charged to our account, to our income statement. Is that point clear, please?
No,
Yes,
sir.
sir.
Please again, sir.
All right. When we have the research and development cost, that cost cannot be deducted as one. It's for a new project that was developed. The company incurred a cost of 5 million to develop a new project. This project is for 5 years and it's going to be benefit, it's going to produce benefit to the company. In this case, the cost of research and development cannot be deducted in one year. You are going to amortize it for the number of years. When we say amortize, it means you are going to spread the cost for the number of years involved. This cost was incurred in 2019 for 5 million naira. And it is for a project for 5 years. Hence, the cost will be spread for 5 years. Meaning, I'm going to divide 5 million by 5 years. 5. That becomes 1 million. That 1 million will be deducted every year for 5 years. Look at it, please. I'll come here. I can show the working here. I'll manage here. 5 million divided by 5. The 5 is the 5 years. That means annually we are going to deduct 1 million. That is amortization of development cost. So we are going to deduct these two items. Please sum these two together. That will give me 51 million, 51.5 million. This will be deducted now. You can now derive your note parts. Your note parts. Your note parts. Please let us add 48 million. 41.2 million. This is our net operating profit after tax. You are going to keep this. We now move to working 2. Let me change the ink. My working 2 is the adjusted capital employed. Please, for the purpose of time, I want to shorten this. I don't really like doing it. Adjusted capital employed. You are going to start with your opening capital balance. When we say opening capital balance, remember we are doing for 2020. We are going to look at the capital employed in 2019. It was closing for 2019. It becomes opening for 2020. What is the capital employed for 2019? Capital employed balance.
That is 500.
500.
Thank you. That is the 500 million we computed before. You are going to pick that figure 500 million plus operating profit, operating lease assets. Go and look at note number 5 or 6. We are giving operating lease. Yeah, look at it. Note number. The company had a non-capitalized lease asset of 18 million in January 2020. These assets are not subject to depreciation. Please add back 18 million. I'll come here, add back 18 million. Plus increase in provision. Increase in provision. If you look at our doubtful debt, in the income statement, the doubtful debt is increase in provision for doubtful debt. If you look at the income statement, the doubtful debt was 1.2 million. If you look at information number 3, the provision for doubtful debt was 2.5 million on the 2020 statement of financial position. That means there is increase in provision. Is that not please? 1.2 million to 2.5 million. What is the increase, please?
1.3.
Thank you. Let's show the working here. 2.5 minus 1.2. That will give me 1.3 increase. In this question, there is no decrease in provision. Plus non-cash item. Non-cash item. Non-cash item for 2020, 3 million. Please add 3.0. Please sum up these 3 items or these 4 items. That is your adjusted capital employed. How much?
522.3.
Adjusted capital employed. 522.3. Thank you.
Sorry, where do you see 5?
Please, I can't hear you. That line is breaking. Are you talking to us?
So where is the 5 coming from? Yes, sir. Where is the 5 coming from?
Okay. Are you saying this is wrong?
2.8. Yes.
500 million plus 18 plus 1.3 plus 3 gives us 522.3.
522.3.
Maybe you didn't see the 500. Let's move to working 3. Our cost of capital now. Let me also do color. Cost of capital. That is my work. My work, the formula is what, please?
AE.
The formula is KE multiplied by percentage. That's
equity.
Percentage of E, close my bracket, plus Open another bracket.
ABT.
Cost of debt, net of tax, multiplied by percentage of debt. This place is full. Oh.
Sorry, sir. Formula 2. Can we say cost of debt in front of that key? The open bracket I say 1 minus bracket.
Yeah, it's very possible now. It's very possible. Cost of debt minus. It's very possible now. Very, very. Just give us cost of debt after tax. So I will need to share, I will need to move to the new board. This place is full. I knew this will consume time. Please, I've taken a new board though. I hope you can see it though.
Yes, sir.
Let me know Zoom. Oh. We continue. Now let's compute our work. Or let's split it out our work. What is the cost of equity given the question?
Sir, I think you should maintain the color you are using.
Okay. Okay, no problem. For work. Work. Now, what is the cost of equity? Are we giving the question? What is cost of equity?
18%.
18%, pick it. What is the cost of debt pre-tax?
6%.
So I'm going to compute net of tax. Look at net of tax. Cost of debt, net of tax is equal to 6 multiplied by, open a bracket, 1 minus the tax. What is the tax rate? 0.25. So what is cost of debt net of tax?
$4.5.
4.5%. Is in percentage. Then, what is the percentage of equity? Are we giving?
Yes, sir. 60%.
What is the percentage of debt?
40%.
We can compute our work now. At this level, now we give you all these things. Sorry, I'm trying to look for my. I want to shift this off small.
So, sorry, sir. If the question gives us the percentage of equity and keep silent on the percentage of debt, we will assume that minus 100.
You are not assuming itself. That is the correct thing to do. The question he asks is that assuming we are giving the percentage of equity to be 60, and the examiner is silent about the percentage of debt. It's a very good question he's trying to put. What you need to do is remember that the total value of the company is 100%. Total capital employed must be 100. Equity plus debt must give us 100. So if equity is 60, and you are not told what debt is, just do 100 minus 60. That will give you the debt. Is that point clear, please?
Yes, sir. Yes, sir.
So our WACC is equal to cost of equity 18% multiplied by percentage of equity 60%, bracket, plus open another bracket, cost of debt net of tax 4.5% multiplied by percentage of debt 40%. Please work this out and give us the final answer for WACC. This must give you, your WACC must give you, you are going to get 0.126 in percentage multiplied by 100. That will give you 12.6%. This company's cost of capital is 12.6%.
All right.
All right. We have gotten the three variables required. We can calculate WACC now. We can calculate economic value added now. We can calculate without wasting time. I'm going to go back to black now. Look at it. Our economic value added. Remember the formula. Note part, 41.2 million minus, open a bracket, adjusted capital employed, 522.5, multiplied by the cost of capital, that is my WACC, 0.126. Yeah, work. Ever is equal to 41 million minus, what do you have here, please? Multiply, or give me the final answer. What are you giving me?
65.835.
55.
65.835.
65.835. So our ever is negative figure minus what? 24 point what?
635.
635 million. Obviously, this company is not doing well. In fact, this company is destroying value. You have wasted 24 million. This company is not doing well. A negative ever is an indication that that company is not doing well. In fact, they're actually destroying value. Instead of creating value for the owners, you are destroying values.
Well, not just one, like we said before, as to identify the immediate or immediate cause of this incident. So we are believing.
Are you talking to us?
Police require an investigation regarding this matter.
Then what do we do, sir?
As much as possible.
Somebody is disturbing the class. That's where I'm going to first.
Do we put this company for sale?
Please just hold on. Somebody is conflicting this class. Okay, hey. Now, the question is, what do we do? Should we put the company for sale? Assuming it's your company and you have hired people to manage the company, you are a shareholder. You are one of the biggest shareholders in the company. And you have hired directors to manage the company for you. And you observe that they have destroyed 24 million. What are you going to do?
Fire them.
Call for external auditor.
Of course, no, they are not stealing your money. Oh.
Okay,
They are not doing very well.
Mismanagement.
Your money. They are not making enough profits, and they cannot finance. They don't have sufficient profits to meet cost of capital, to meet cost of funds. Look at the cost of funds. The cost of fund is 65.8 million. Profit generated is 41.2. That means the profit is not sufficient to cover your cost of funds. The money you have borrowed and the shareholders' money, they are not making enough money to meet cost of funds.
Yes.
So what do we do with this manager?
Fire.
Okay.
I change the.
Excuse me, sir.
Yes, we are listening.
Sir, please, I want to draw your attention to something. The IVA that you wrote for 1.2 minus 522.5, but the adjusted capital employed is 522.3, not 0.5.
So who is speaking, please?
Tife.
Okay, it's 0.3 we have, Abby.
Yes.
Oh, okay, thank you.
So that makes our this thing to be 65.8098, not 835.
Oh, okay, that's fine.
That does not make them declare profit.
But it's good that we have to correct it now. So we are going to get 65 point what, please?
8098.
8098. So we can say approximately 81. Is that correct?
Yes, sir.
So what do we have here? Final figure here?
24.61.
0.61. Okay. Thank you for the observation. So please, this company is not performing well. They are not creating value for the owners. They are destroying values. We might need to look for, we might need to hire someone to advise us on what to do with these people. We are done with requirement B. We are done with requirement B. Let us look at requirement C. Requirement C says, calculate the net present value of the solar project for the life of the investment. Calculate the net present value of the solar project for the life of the investment. If you look at this question, this is entirely different from the topic we are treating. This is about investment appraisal. I'm not sure you have started investment appraisal. You weren't supposed to take you investment appraisal. I'm not sure you have started. But we can deal with this question. How do we compute net present value, please? Look at the question. It's coming from this last note. The company had the opportunity to invest in the solar projects that will require the procurement of an equipment worth 3 million in January. That means the initial investment amount is 3 million. The project will run and we run for a period of 5 years. The project is for 5 years with a salvage value of 0.5 million. Your salvage value is your residual value, generating a stable net cash flow of 0.85 million. The applicable cost of capital is the associated weighted average cost of capital of the company. Now, should we go ahead and compute this? I think we should calculate it.
Yes, sir.
Instead of leaving the question, I want to calculate net present value. Let me, although I believe that we should have gone through NPV before now in our previous classes.
Yes, sir.
Albeit, I will try to explain it because even those coming from foundation, for you to cross foundation, you must have done NPV in a, what's it called, BMF. So let's try to look at it together. Now I've shared a new white. This cannot take me 5 minutes, but because I'm being careful that some might be wondering what are we doing. We want to calculate net present value. You are going to open a schedule. Your year. Let me add the items, then the cash flow, the discount factor, then the present value. In year zero is now. We are going to get equipment for the project. The equipment for the project, equipment cost, is going to cost 3 million naira. That means we are buying the equipment for the project. If you are buying, that's an outflow. You are going to spend 3 million to buy the equipment. Year 1 to year 5, the project will generate net cash flow of 0.85. That means in year 1, you are going to get 0.85 million. Year 2, you are going to get 0.85 million. Year 3, you are going to get 0.85 million up to year 5. Then in year 5 again, you can dispose this equipment for a salvage value. This salvage value is also called residual value. You can dispose this equipment and get 0.5 million. What is the NPV now? You observe that in year 0, you have 3 million in bracket. That is initial capital outlay. Year 1 to 5, you are going to generate cash inflows of 0.85 million every year. That is an annuity. We call it annuity. When you receive or paid a constant amount of money for a number of years, that is called annuity. Year 5 only, you are going to get 0.5 million as the salvage value. Your salvage value is your scrap value. You can dispose the machine and realize 0.5 million. Now the question also says that, look at it. The applicable cost of capital is the associated weighted average cost of capital of the company. And we have computed. What is the weighted average computed, please?
5.6%.
That is your cost of capital. That is your discount rate. That is at 12.6%. Some of us, we understand this. To calculate your discount factor, what's your discount rate? discount factor formula?
1 minus r raised to
Anybody?
power 1 minus r raised to power minus n.
1 plus r raised to power minus n. This is the formula for discount factor. Now, what is the formula for annuity?
1 minus bracket open 1 plus r raised to power minus n all over r.
1 minus bracket 1 plus r raised to power minus n all over r. Like I said, Adejuwon will still take this topic fully. So if you are not having it 100%, please do not exercise too much fear. It's not a topic we are treating today, but it was part of the question that was asked. So your discount factor for year 0 is always 1, is constant. I will now calculate annuity factor, year 1 to 5. I'm going to come here and do like this will equal to 1 minus bracket 1 plus. My R is 12.6%. That's my cost of capital. 0.126. I'll close my bracket. Raised to power n. N is number of years. Number of years here is 5 years. Minus 5. Everything divided by R. Everything divided by 0.126. You are going to apply your calculator. Please compute the annuity factor if you understand this.
3.55.
That's correct. 3.55. Now compute your discount factor for year 5 only. Using this formula now. 0. If I'm not mistaken. Is that correct, please?
Yes, 0.552.
2, Abby?
Yes, sir.
You now multiply the cash flow by the discount factor. 3 million multiplied by 1. That will give me negative 3 million. 0.85 multiplied by 3.55. That will give me 3 point what?
3.0175.
3.0175. 0.5 multiplied by 0.552.
0.276.
0.276. You can now get your MPV. You are going to add the positive, then deduct the negative.
0.2935.
0.2935 million. Once you have a positive sign, it means that that project is financially viable. Your MPV is positive 0.29. It shows that the project is financially what? Viable. MPV is equal to. We are done with this. Yes, please.
Sir, please, sir, how did you get the 0.552?
You know the question I asked. You know how to compute MPV. Have you gone through MPV before?
Yes, sir.
Okay. That means you can calculate discount factor.
Yes, sir.
So compute discount factor for year 5. For year 5, with discount rate of 12.6%. Discount factor for year 5 with a discount rate of 12.6%. What do you have, please? Yes,
Sir,
Mr.
please,
Tekno, you can ask your question.
Thank you, sir. Sir, that of the cash inflow for the outlay and for the one beneath it, I think the inflow should be because the inflow is equal throughout the years from year 1 to year 5, Abi? That is the one you call annuity.
Yes.
Okay, if it were to be that the inflow are not equal, then what do we do?
You cannot use annuity again. You are going to do it 1-1.
Like the one we did for year 5, Abi. Okay, sir. Thank you, sir.
You're not saying year 1, year 2, year 3, year 4, year 5.
We'll not table it like that, 1-1 differently.
Yes.
Okay, sir. Thank you, sir.
Yes, the first question here. I'm waiting for your response. Discount factor year 5 only at 12%. Is the person still online?
Is it 12% or 12.6%?
12.6%. The person is still keeping quiet. That's why I asked that. You know,
sir, I'm
here.
I'm not getting it. Sorry, sir.
And no,
I thought I
asked a
unmuted
question.
myself while talking.
I asked a question. I said, have you gone through MPV before?
Yes, sir. Sir, I know
Look
how we got this 3.55. I computed it.
1 plus 0.126 raised to power minus 5. That's what is putting the figure.
Yes.
So what do you have?
I have 3.55 for that year 1 to 5.
Year 5 only. What do you have?
That's what I'm saying. I don't know how I'm going to punch it on calculator to get that figure.
I've stated it out for you now.
Okay. I'm coming, sir. Okay, sir, I've gotten it.
You know, that's what I was trying to ask, Daddy. You know how to do it.
Thank you, sir. I've gotten 0.52. Thank you, sir.
You're welcome, please. All right. We are done with our question. Excuse me. The time is always, it's because we are solving this online. As me, it's not, we are using, what's it called? We have 15 minutes. And I wait to solve 2 questions here, sir. Using my time gone. I can't finish this one. This one is even long. I will just be rushing you.
I don't meant to be rushed.
But we cannot stay on one. You stay too much on one topic. It's not good for the classes.
That's true, sir.
All right. Let's look at this question. Karosi, I will read. No, I have 15 minutes.
You can't finish it.
The 15 minutes will be enough for you to read, sir. You may not attempt.
No, we can finish it in 10 minutes. Number B is the B part. Okay, let's do it. Don't worry. Please go and read. Question. This question in section 5. Karosi. Are you there?
Yeah, I slept though.
Ah.
Sir.
Yeah, I've gone to sleep.
Joy is not online anymore.
Bobaton. All right, let's take the reading. Maybe she felt that we are done. We can't do any question again. Or our network is throwing her house. Okay, while we look at this question, please, I will encourage us to attempt, take it as an assignment, attempt this question on IBOK. Attempt this question on IBOK. Let me see how far we can deal with economic value added, really. Okay, I'll read. Karosi Limited makes quality wooden products such as table, chairs, benches, doors. Historically, the company has used many financial performance measures to assess performance of the company as a whole. The Chief Executive Officer has just been informed of the balanced scorecard approach and is eager to learn. Karosi has 2 divisions, X and Y, each with its own cost and revenue stream. Each division is managed by a divisional manager who has the power to make all investment decisions within the division. The cost of capital of both divisions is 15%. Historically, investment decision has been made by calculating return on investment of any opportunities. Presently, the return on investment of each division is 18%. A recently appointed manager for Division X strongly feels that using residual income to make investment decisions will result in better co-congruence throughout the organization. Each division is currently considering the following separate projects. Division X and Y, capital required for investment is given, revenue generated for investment is given, profit margin is given. The company is seeking to maximize wealth of shareholders. Requirement 1, describe balanced scorecard approach to performance measurements. That will not involve calculation. 2, determine return on investment and residual income of the new projects for each of the divisions. Then lastly, comment on these results and take into consideration the manager's view about residual income. For requirement 1, that's not the problem. We are still going to get to balance scorecard. Requirement 2, we are to calculate return on investment. Now look at the question. How do we compute return on investment? My profit over capital employed. That is capital investment. If you look at this question, you are not giving the profit directly. You are giving the profit margin. The profit margin for division X is 30%. The profit margin for division Y is 35%. If you are to compute your, let me open a new whiteboard. I want to take this, it won't take me 10 minutes really. One minute. Trying to bring up one whiteboard. Okay. Please confirm you can see my whiteboard being shared.
Yes, sir.
Yes.
Now, if I'm to compute, that is for requirement 2 now. I want to calculate return on investment. I have division X. I'm giving capital investment. What is capital investment division X? What is the capital investment division X?
88.2 million.
88.2 million. What is the revenue generated?
46.4.
46.4 million. What is the net profit margin?
30%.
Net profit margin. I'm giving 30%. I can now get the profit in Naira amounts. The profit is equal to 30% of revenue. That is, your net profit margin is 30%. 30% of our revenue will become the profit. Please compute 30% of 46.4 million.
13.92 million.
That means the profit for division X profit for division X is 13.92 million. Therefore, return on investment for division X. Return on investment for division X is equal to the profit over capital investment. 13.92 million divided by 88.2 multiplied by 100/1. What do you have, please?
15.78%.
15.78%. If I'm to calculate return on investment for division Y, on investment for division Y, division Y. Let me use red. What is the investment for division Y?
46 million.
Investment 46 million. What is the revenue for division Y?
28.1.
28.1. What is the profit margin for division Y?
35%.
35%. Therefore, I can get the profit in Naira form. 35% of 28.1. Please, what do you have?
9.835.
9.835 million. I can get return on investment for division Y. This is equal to 9.835 over 46 multiplied by 100. What do you have, please?
21.38%.
21.38%. We have gotten return on investment for both divisions. Is that clear, please? If I want to calculate residual income, for division, oh, sorry, this is an error here. Division Y. Residual income for division X is equal to profit minus bracket capital employed multiplied by cost of capital. For division S, the profit is 13.92 minus capital employed for division S, that is capital investment, 88.2 million, multiplied by, what is the cost of capital?
15%.
Look at it, please. 15%. Multiplied by 15%. Please, what is residual income for division X? Final answer.
0.69.
0.69 million. If I want to calculate for division Y. Division Y, residual income. I'll just come here. Profit for division Y, 9.82835 minus, open a bracket, capital investment for Y, 46 million, multiplied by cost of capital, 15%. Please, what is residual income for Y? Final answer.
$2.935.
Just one, 2.935. $2.935 million. We are done with the computation. The number 3 is just writing. Explain your answer. Look at it. Comment on this result and take into consideration the manager's view about residual income. Now, if you look at it, before the comment, the question says, currently, both divisions, presently, return on investment of each division is 18%. Now, if you look at the calculation, for this new project, return on investment for division X will be 15.778%. That means this new project is giving division X a return on investment less than what the company is currently earning, 18%. Division X is likely to reject this project because currently the company is earning 18% return on investment. The new project is promising 15.78%. Division X is likely to reject this project. If you look at for division Y, return on investment for this project is 21.83. Division Y will accept the new project because the new project is giving them a return on investment higher than what the division is currently earning at 18%. However, if you have used residual income, both projects will give us positive residual income. Both projects are actually financially viable because they are giving us positive residual income. That means if division S should reject this project, they are losing profits, even though the return on investment is lower, but the project is still giving profits. 0.69 million. That is what the new manager is saying, that residual income is a better way to assess a project because it will show the profit you are making in absolute terms. Residual income is better to assess projects than return on investment. All right, I'll stop here. We have taken 5 minutes extra. I think that is sufficient. Please attempt question number 4. Let me see the extent to which we can go. We have, yes, your question.
The absolute term you mean is that the residual
Naira terms.
The Naira, okay. Thank you, sir.
Oh, that's what we call absolute now. You have percentage form and absolute form. If I say 1 million naira, that is absolute. If I say 10% increase, if I say profit increased by 1 million, that is absolute terms. If I say
Okay.
profit increased by 10%, that is percentage form.
Okay, sir. Thank you, sir.
All right. We are going to be closing the class now. May God give us a better understanding. Good night.
Amen.
And
Amen.
remain
Good night,
blessed.
sir.